The Construction Market Guide is designed to provide contractors and construction executives with timely data on the economic environment, materials prices, and the labor market so you can make informed decisions that increase profitability. Over the last week or so, we're hearing a lot of talk about the Federal Reserve. The Federal Reserve Bank in the U.S. has two jobs: to maintain full employment and stable prices. And as you can see from these charts, while they're maintaining full employment at a national rate of about 3.9% and a construction unemployment rate that's down to 5% now, they're not doing so well with that stable prices thing. The numbers just came out in December, 7% annual inflation, and we see this translated across a pretty disparate set of numbers here in the materials cost index, with oil prices up 32% over the last year, iron and steel prices up a whopping 46.5%, and asphalt and paving mixtures moderating a bit. Lumber, same thing, but they had experienced dramatic rises earlier on in the pandemic. So the Fed is taking action. There are two aspects of inflation that we hear talked about. One is cost push inflation, which is just an increase in the cost of labor and materials. And I know we're all seeing that today as we're just discussing. And so that is causing companies to be forced to increase prices in response to the increase in their input costs. There's also demand pull inflation, which is when the demand for goods and services outstrips the supply, and so prices rise. And so the Federal Reserve is really trying to respond more so to that second aspect by pushing up interest rates, which is essentially tapping the brakes on the U.S. economy to try to slow down demand. And we're seeing that already with increases in interest rates, which affect the cost of construction projects. The financing cost also pushes up mortgage rates, and it's having ripple effects throughout the economy, which is one of the major reasons we're seeing a dramatic and sudden effect on the stock market. Despite that, construction sentiment looks pretty strong. The Architectural Billing Index, particularly new inquiries, continue to be strong nationally, although we see some weakness here in the Northeast. Still strong across the board nationally, though, and new housing starts continue to be strong. As I just mentioned, interest rates have increased pretty dramatically over the last few weeks, and that has resulted in a massive disparity in stock prices more recently. We see here growth companies, which are more heavily impacted by interest rates, in particular an increase in interest rates, have seen dramatic pullbacks. Some of the highest growth companies or companies with the highest growth rates, who may or may not have earnings depending on the company, have seen pretty dramatic pullbacks. From Zoom Video, which was a darling of the COVID era, DocuSign, same thing, Netflix, Roku. These companies have seen massive pullbacks in recent weeks, while the companies that were most hated during COVID era, like ExxonMobil and Chevron, as well as banking companies and even Caterpillar, value companies are seeing dramatic increases in price, moderating more recently over the last week or so. So again, across the board, the stock market is seeing modest declines. Again, we usually see a pullback of 10% or so about once a year. We've seen about that as the pullback we've seen recently, based on concerns about the Fed raising interest rates and the potential that they tap the brakes a little too hard and push the economy potentially into recession or really slow down growth going forward. So I think it's an important time to take a look at your investment portfolio. There are many strategies that may make sense to consider, from Roth conversions to rebalancing portfolios, to look at buying aspects of the market that have really pulled back and potentially trimming other aspects of the market that might have performed better to rebalance your portfolio. If there are things we can do to review your finances, your financial picture, or help you with your business, please reach out to us. We're happy to chat. Thanks.